Good evening, everyone, and welcome. I wish all of you a very happy new year. And once again, this is a new year 2021, and we have started our series of webinars. We had done a lot of sessions in the year 2020 and related to different topics, related to different issues. Today, we are doing this session, which will talk about the investment opportunities in 2021. We'll do a brief recap of 2020, that how the asset classes in 2020 have performed. We'll talk about what are the expected stocks, which are the expected stocks which can perform well in 2021. What will be the impact of Joe Biden's presidency on US and the global economy, mostly on US economy, how the recent blue wave, where we are looking at a blue Senate, the Congress is blue, the White House is blue, and it's a complete democratic sweep, which we have seen in last 2-3 days. So how it's going to impact these stocks, how it is going to impact the currencies. We are also going to give a brief about how you can actually diversify your portfolio of stocks. You can invest into different ETFs. You can invest into sectors, maybe which are not just tech sectors, because a lot of companies which were related to technology have outperformed last year, and it has still been going high. I'm sure you will have questions regarding Tesla and other companies. Then, last but not the least, we are going to talk about what is the outlook on financial markets in the coming year. So I have a couple of portfolios with me. I have this presentation with me. We are going to switch, here and there, and then all I need from you is nothing has changed from 2020 to 2021 in the way how I'm going to conduct this session. A notepad should be with you. A pen should be with you, because those I see a lot of names over here who have attended my sessions before, and most welcome in these sessions. And I'm seeing a lot of names who are new, which I have not seen before in my webinar. So I see a lot of people joining today, and it's a good topic, investment opportunities in 2021. Everybody has been talking about which could be the areas where we can look into. Before I begin, please let's understand one thing. There will be a few stocks which I'm going to share with you, and these are statistics and data which is prepared by our research, and everything what is prepared and what is given to you, it is on the basis of some fundamentals and some technicals which are working now as we talk. Obviously, the success of these portfolios, the failure of these portfolios, it depends upon how the market shapes up in the future. But that doesn't mean that we should not try to predict what is going to be, how the market is going to be in the next year, because everybody invest, everybody has to take investment decision, and the very foundation of those investment decision can be either a fundamental or can be a technical, which means it could be based on the historic pricing of a commodity or an instrument. So please understand this, that the markets, the financial markets, will always have a certain amount of market risk. And this is not one of those sessions, I always say this in my sessions, that this is not one of those sessions which is going to promise you a big car or a big house, or is going to share any tricks or any tips of trade. There is no insider information. There is no magic on this session. I do not have a package of pen drives which I'm going to sell it to you for an X amount, which if you install in your system, you're going to be rich. This is not one of those sessions, and I'm not one of those people. All I'm going to tell you about is what are the expectations, realistic expectations in the coming year, what has been going on in last year, how those markets have performed, and what you can expect in the coming next year. Before we start, let's have a very quick poll to understand who invested. I'm sure there are a lot of people right now who are thinking about what's going on with the vaccine, what's going on with the strain, what's going on with what happens if a new lockdown happens, how it is going to impact my investments. Tell me first that did you invest in the global stocks? I'm talking about US stocks, I'm talking about European stocks, I'm talking about Chinese stocks, any stock markets you have invested during the lockdown, because during the lockdown the markets crashed. And again, I cannot see the names of people who are answering the question. It's just in percentage. So I just want to know what kind of crowd I'm dealing with. Because had you invested in stock markets during the lockdown, by the end of the year, you would know that why we need to understand the investment trends. And sometimes risk and reward is directly connected to market volatility, because sometimes if the volatility is too high, even if you take higher risk, you might end up even if you take a lower risk, sorry, if the volatility is too high, fluctuations are too high, even if you take a smaller amount of risk, it can give you very big rewards. And that's the one idea which we have got when we saw the lockdown happening, and when we saw people investing in equities. There are people who have made 200% returns, 300% returns. So 5 more seconds before I end the poll, and I'll disclose the results as well. 5, 4, 3, 2, 1. So 38% out of the crowd, they have invested in the global stocks during the lockdown. I'm sure this 38% must have seen a lot of gains. 61% did not invest during the lockdown in global stocks. So nothing to worry. All I'm saying is today we'll go through the investment trends back in 2020 and try to understand what happened, how the 2020 shaped up, which were the sectors which did really well. So you can get an idea of how 2021 is going to be like. Before, again, please, if I'm seeing some comments on the chat, if there is a problem in the audio, if you can hear my voice properly, give me a okay or a yes, so I can proceed with my session, because network congestion is very common. These days, webinars are at its peak, so I'm not surprised if this platform, such kind of platforms have been used more and more. If you can hear me properly, please give me a yes or a okay. If you can see my presentation, okay, great, perfect. Oh, I see an old friend from UK, from different parts of the world. Brilliant. Okay, that's great. So perfect. Now, I'm sure you will be having a lot of questions also. Please keep writing on the chat. We used to do a lot of webinars in 2019 before the pandemic hit. And then we made webinars, our new seminars, but we cannot talk to people live. So we are taking their questions. Do write all your queries and questions. By the end of the session, I'll be able to take a few questions, and also one-on-one sessions are available. Anytime you want to understand more about how to take a trade, how to place a trade, what kind of risk do you face, how to control your leverage, I'm available for a one-on-one training session, and all those are free of cost. All you have to do is talk to your relationship managers, and that's it. So to begin with, how 2020 performed, and please keep a notepad with you, or just use your phone or any pen and paper so you can keep writing. I have a pen and paper, so I have a habit of every time I speak, I write. So that it kind of gives me a good retention, and I think it's going to give you also a very good retention. So use your pen and paper, use your notepads and pen. When we talk about asset classes performance in 2020, the chart which you see right now, it shows you different asset classes like silver, gold, which is commodities, US small caps, which means domestic companies of US, the smaller market value companies. Then there are US stocks, which means a global stock market of US. emerging market stocks, emerging market on the likes of China, Brazil, India. Then US corporate bonds, which means the companies which are in US, they issue also bonds, companies like Boeing, FedEx, and others, how the US corporate bond markets performed. Then European, Australian, Far Eastern stocks, US treasuries, which is US government bonds, Canadian stocks, commodities, dollar index, real estate, US real estate in specific, and then crude oil. Now, the green portion and the blue portion which you see are returns. Green are positive returns and blue are negative returns. So as you can see from the bottom four, the overall commodities market ended up with a negative return of 6.6%. And commodities include your natural resources. I'm talking about agro-based commodities, which includes, it may include oil. So agro-based is different. Agro-based is agriculture. Commodities can include gold, oil, and then agricultural-based commodities combined. But if you see at the bottom, crude oil performed negative 21.5%. Now, this negative 21.5%, which means oil prices, as compared to 2019, when you compare 2020, the maximum drawdown, what you saw was 72%. The max drawdown, which you see, guys, on the extreme left of crude oil, it says 72%. So that was the maximum drawdown. Maximum drawdown means the highest you could have lost in oil in your investments would be 72%. But at the end of 2020, it ended with a negative 21%. So those who are not able to understand this, I'm talking about the time when oil prices went negative, minus 40. And then it recovered. And by the end of 2020, it was around 47 or 48. So had you invested in oil in the beginning of the year, you could have seen 72% maximum decline in your investments. And by the end of the year, oil prices ended with a 21% decline. Similarly, if you look at US real estate, had you invested in US real estate, the max drawdown which you could have lost was 38%. And by the end of the year, what we saw was negative 6.4%. Now, similarly, if you see from the top, gold and silver, these are two metals which have outperformed. Especially silver is very important because during the pandemic, March, we saw silver going down almost 34%, and that was the maximum loss you could have faced in your investments in silver. But then it recovered from its pandemic lows and went 120% high. And then by the end of the year, it ended with a good 47% return. Similarly, if you see gold, it ended with 24%. The domestic companies of US, they, after going down by 42%, the maximum loss, it recovered from the pandemic, went up by 100%, and then again came down, ended the year with a positive 16% to 18% note. Now, why this performance is important? You will say that it's 2021. Why do I even care about how 2020 performed? This is to show you the volatility, the range at which a market can operate. Something like silver can go down by 34%, recover from the previous lows, go up by 127%, and then end the year with a net return of 47%. This is the depth of the market. This is a huge range which we saw in 2020. Obviously, 2020 was an exceptional year. And when I say exceptional year, it was never expected how the investments are going to perform. But this is the returns which we have seen. So to sum up, we can say among asset classes, gold and silver outperformed definitely as compared to their 2019 returns. We saw increase in 2020. US stocks ended the year on a higher note. Even after a max drawdown of 30 to 40%, they ended the year on a higher note. So had you invested during the lockdown, you would have still ended up on a higher note. We're talking about European stocks. Australia, Far East ended up on a general humble return of 5%. Then you're looking at Canadian stocks, net increase of 2%, and there it goes. So please understand it this way, that it is very important for you to diversify your portfolio. Had you only invested in stocks or had you only invested in bonds, it would not have given you much recovery, but had you diversified your portfolio into commodities, could have given sufficient amount of return, right? So that is one important thing which you need to know. Now, moving further, how about the different stock sectors? S&P 500 is a stock market index which tracks the performance of 500 uh, major stocks in US. This could be belonging to different sectors: IT, materials, healthcare, financials, real estate, energy. Let's see how which sector has performed well, and it is a no-brainer. IT, information technology, IT stocks have outperformed entire 2020. Reasons being, there was a reason, of course, work from home happened. So companies like Zoom, companies like Netflix, companies like Amazon, these kind of companies, Alibaba, these kind of companies, they outperformed every other company because they were very much in demand. Their business was very much in demand. So we have seen a lot of IT stocks performing well, and among this IT, the industries related to cybercrime solutions, the industries related to mobile payment, industries related to AI and robotics. There are a lot of industries within IT which you can personally look at. So all of these sectors now in 2020, they have performed well. And we have seen a 41% growth in the IT stocks after they went down by 25%, which was the maximum drawdown which your investments could have faced. Again, when I say maximum drawdown, I'm talking about a maximum loss which your investment could have seen in this. Guys, please, for those people who are not able to hear me properly or are facing a congestion, do not worry about this. This will be recorded on YouTube. A recording will be there on YouTube, so you can visit this later. Or I can conduct a one-on-one session separately for you on your request, and we can discuss about this one-on-one as well. So do not worry if there is a small congestion in the network, or if you're not able to hear me, or if you missed something out. This will be recorded on YouTube later, and you can always check this. Right? So we are looking at IT as the best performing sector in 2020, consumer discretionary, consumer services, materials. So guys, consumer discretionary, I'm talking about the luxury brands. That is what the consumer discretionary is. So you have seen it ended on 32% higher note after showing a max drawdown of 33%. Then we are talking about communication services, talking about materials, healthcare, which have also ended the year on a higher note. Had you invested in healthcare stocks, you would still end up on a 10% net increase as compared to 2019. So the worst performer, as you can see, is the energy. Oil prices went down, pandemic was there, no demand for oil at all. So that was something we saw a lot of oil companies hitting all-time lows, whether you talk about Chevron, ExxonMobil, British Petroleum, Royal Dutch Shell, all these companies, they went down. So we have seen energy stocks, energy sector have ended this year with a negative 37% return. That is one way to see it. Another way to see it, that good companies also have ended the year on a negative note. So futuristically, maybe a good point to enter in few of the energy stocks which have good dividends and are less volatile. So this is something which you can again look into. If you see FX, foreign currencies, I'm not going to talk about Bitcoin over here because Bitcoin has completely, it would not even fit into my chart, which I have to show you. Cryptos have completely performed in, it has definitely outperformed, but Bitcoin and other cryptocurrencies have a lot of risk. And the reason of going higher or lower is something which it will never be clear until it gets a wider legitimacy. So I would suggest you, if you have to invest in Bitcoins, please understand the fluctuations and volatility and understand the risk behind it. It is a very, just yesterday, when I was having a word with a client, yesterday itself, the Bitcoin prices went down by $10,000 in one day. So this is something, it's not about you buying one coin or 0.5, it is all about how risky this can be. To look at other currencies, Australian dollar ended the year on a positive note, 9% up, followed by Swiss franc, euro actually recovered, New Zealand dollar, Chinese yuan, and Japanese yen. Japanese yen, even from an outlook point of view, it is still very attractive for 2021. So investments in yen still continues to increase. British pound increased net by 3.1%. So there have been a lot of talks about the Brexit deal. And let me tell you what has happened. When we talk about stock markets and in UK and pound, the UK index did jump almost by 1.5%, and it was hours before the Brexit trade deal with the European Union was announced. Now, there's a lot of market positivity, but the only thing now is which is bothering everyone, and I'm sure people in UK, you must have seen, the health system is very, very stressed, and the coronavirus cases are. There is a big record number of cases, a big increase in the record cases, the new strain. If we see, of course, the UK central bank governor, the Bank of England's governor, Andrew Bailey, is under pressure to cut rates and put it to negative levels. So what we are looking at currently is, for pound, it is still neutral to bearish, because if there is a further decline in interest rates and if the interest rates continue to go negative, then pound might become more weaker. Even if you see data-wise, UK does not have much relevant to offer. And when we see now, the governor of Bank of England, he has already warned that Brexit would mean a 4% on GDP. Now that's something over a long term which UK has to understand. So there is a lot of, if the negative rates really follow to save the GDP, then we might see pound getting a bit weaker. So on a longer term chart, on a 2021 level, there is a possibility that a lockdown, a tough lockdown, if the cases continue to increase and if the health system remains this stressed, then it might be at a brink of collapse. So they have to come up with a really big plan to at least vaccinate each and every citizen they can, increase and accelerate the immunization, and that is something which can be done, and that can only show us where the pound is going to be. Till then, the impact on GBP, it can be bearish, which means it can be on the downside. So what I mean to tell you is that every news affects. And when we talk about, so British pound ended the year on a positive note. And the moment the next year started, we started listening to about the new strain, about increasing cases, about tier 3, tier 4 lockdowns. So with that being into the picture, and negative rates might follow from Bank of Governor Andrew Bailey. And if that happens, then we might see again a bearish stand on the pound, which means a downside. Now, Indian rupee ended on a negative note. 2021 for Indian rupee, if the oil prices remain down and if it goes down any further, there's a possibility that Indian rupee might bounce back, because even in 2020, there has been a lot of foreign institutional investments. There has been a lot of foreign direct investments in equity markets. In spite of that, INR has remained weaker. So this time, probably the central bank is expected to interfere. And for 2021, we might see INR actually getting a bit stronger due to the continuous central bank interference, and at the same time, declining of oil prices can push INR much stronger as compared to dollar. So dollar index ended again. Dollar was bearish throughout 2020. And there was a lot of reasons, talk about elections, talk about pandemic, talk about trade war before that. So there was a lot of chaos. We saw Russian ruble falling almost around 16.5%. Talking about Bitcoin, since we have not put this in the chart, but if, as you can see, it has gone really high. Cryptocurrencies had a maximum drawdown from 2020 open to 46%, 300% returns overall for the year, and returned 651% from the 2020 low. So if you see how low cryptos went during the pandemic, from that lowest to the highest, the return was 650%. But if you see year-on-year increase in the cryptos, it is around 300%. The maximum money you could have lost in cryptos had you invested was around 46%. So this is something which can keep a note. Again, guys, this statistics is important because in 2021, on the basis of this, we'll see how the recovery happens and what is the expectation. If for example, as I said, if INR is at a weaker point right now, if it has ended 2020 on a weaker note, further policy changes or a further foreign institution investment pumping in India, the INR might get stronger. So we have to see the current levels to understand what is going to be the forecast for the next year. Now, after foreign exchange, let's see the winners and losers of 2020. These are few picks which we have picked out, looking at how the markets have performed. Novavax, we all know about Novavax, the healthcare and pharmaceutical. It went up by 2,731%. Not sure. I would like to ask, anybody invested in Novavax? Anyone bought Novavax? I mean, I'm not expecting a 2,700% growth in your portfolio, but if you bought Novavax for a smaller period of time, anyone? I mean, don't write a no. If anyone did, just send me a yes, and I will congratulate you personally. I think there is. Okay. It's kind of a shame. I just got one yes. Congratulations. I'm sure you must have made, if not 2,700%, then at least some of it. So Novavax was the first, one of the best stocks which performed well, followed by, surprisingly, Tesla. Tesla has shown 745% growth in 1 year. Now, this is phenomenal. This simply means that had you invested in Tesla in the beginning of the year, your investments would be up by 700% by the end of 2020. Moderna, again, we have heard these names, Moderna, Novavax. These are the ones who created vaccines when SARS was there. So Moderna went up by 430%. Zoom Technologies, a name which now we are very much familiar to. Zoom Technologies. Okay, somebody did invest in Moderna, so that's good. That's good. Zoom Technologies went up by 400%. Bitcoin, as I said, went up by 300%. And I think it has been going higher and higher. But again, with Bitcoin, as I said, the investments are very, very high risk. So be very careful when you buy a Bitcoin. And then a lot of IPOs were launched during 2020, and the collective growth was around 100%. So even if you invested in all the IPOs together, the growth rate is around 100%. However, the poor performers, the losers of 2020, Carnival Corporation, it's not rocket science to guess who were our losers. These are the companies related to travel, tourism, hospitality. Carnival Corporation down by 57%. We also saw energy stocks. As we saw oil prices going negative in April, we saw energy stocks going down by 38%. So note this down, guys. We have seen energy stocks losing almost 30 to 40% of their value. Any good oil companies over the future, it could be a good bargain to enter. And again, we can, with the help of the consultants, we can pick out for you that which can be a good company. Then companies like Air Canada, 53%. Oil, over and over, WTI ended up 22% negative. FTSE 100, which is the UK stock market index, ended the year down by 14%. And then dollar index, as we saw, ended the year by 6.8%. So these were winners and losers. And as you can see, Tesla, Zoom, and most of the IPOs, there were a lot of tech IPOs as well, have outperformed. Novavax and Moderna has outperformed, which is pharmaceutical, healthcare, and tech. So these 2-3 sectors outperformed, while the energy and hospitality, travel, tourism, these kind of sectors have lost. Now, coming to the point, we talked about winners and losers. Now, what is in there for 2021? So before we try to understand what has happened in last few days, this particular slide is closely linked to what I'm going to tell you. I did a session on US elections, and that was in November and December, where we stressed on what is the expectation of Joe Biden coming into taking over the White House. Which are the sectors? What is going to happen to corporate taxes? What is going to happen to fiscal policies, monetary policies? And that time we did not take into account, because democratic sweep was something only in the book. It was not at all expected that Joe Biden will win with full majority, and not only the White House will be a Democrat, but also the Congress will also be a Democrat. So we, at this point of time, are showing you a scenario. Now, 2 days before, we saw the Democrats clearly won the Senate. They already have the House. Now the president is also a Democrat. So it's a complete blue wave which has come. Now, what it could mean for corporate taxes. Now, there are a lot of situations, guys, happening over. This may happen, may not, but this is something which is, it can be, given the fact, if everything goes well, and over the next 4 years, if things getting back to normal, Democrats are a firm believer of corporate taxes. And during the Trump era, we saw the tax cuts, and Joe Biden has repeatedly said that they will increase the corporate taxes. Corporate taxes are the taxes which are charged to the companies on their profits. And if the corporate taxes increase, the company's profit decrease, which means it affects their earnings. And if earnings get affected, the stock value goes down. So that is something which is a really big surprise with the democratic sweep coming in. So you can be prepared over the next 4 years. If a tax increase happens and corporate taxes go up, it might affect the stocks in a negative way. Similarly, about personal taxes, Democrats feel that if they feel the rich should pay more, and that is why raising taxes on high net worth individuals from 37% to 39%. This was something which was always talked about. Minimum wages are expected to increase. Now, if minimum wages increase, think about the labor intensive companies like McDonald's or Uber. For them, the profitability might be reduced. So you really have to find out, if we keep a check on this news, because if minimum wages started increasing, you have to shed all those companies from your portfolio which are labor intensive, because their profitability will get affected if the wages increase. And then comes the stimulus part. Now, Democrats are the firm believer of providing more and more stimulus to the market. $2 to $3 trillion pandemic stimulus, again, towards infrastructure and towards the economy. So that could be a good booster for the stock markets. We have the next 4 years to see how it turns out. Now, looking at the healthcare, expected to cut the drug prices, expand Obamacare, look forward to enter into climate agreements which Trump took exit from. So if I'll show you the graph of the renewable energy basket, all those companies clubbed together in one renewable energy basket. After the elections, we have seen the renewable energy basket completely going higher. So a lot of focus is given on renewable energy and green and clean energy at this point of time. And similarly, on the other side, during Trump's tenure, the tech firms, they flourished a lot. There were very few restrictions on technology companies like on the likes of Apple's and Google's and Facebook. With Democrats coming in, again, those kind of regulations might be tighter over the next 4 years. So you have to be very careful of the tech sector. Foreign policy, still restrictive against China. It is expected to continue, but then it will be a much more softer. They're trying to form allies. It's not going to be like Donald Trump. So less excitement, but over here, still a lot of restrictions which might continue. Question is asked over here, which sectors will go down and which sectors will go up due to taxes? Can we have some names? So see, it depends. Now, when we talk about taxes, corporate taxes will impact the entire stocks completely. I can tell you, instead of that, I can tell you that which are the sectors which Biden favors. Now, companies related to renewable energy like Tesla. If you see Tesla's performance from November, I mean, Tesla has performed way better throughout the year. But then we have seen, if you talk about, let's say, companies like Tesla, Tesla has went up way high. And after the elections came in, we saw the results came out and we saw further increase in Tesla stocks. Why? That is because Joe Biden and the Democrats, they are the firm believers of green energy and clean energy. Now, that is something which you have to understand. All those companies which are related to green energy, whether it is Jinko Solar, whether it is Tesla, whether it is those companies which are heavily invested into formation of clean energy, they will get a very, very big boost up. So this is something which you can always look into. Another question, what does TPP stands for? So TPP stands for Trans-Pacific Partnership. And this was an agreement between Australia, Canada, Japan, Malaysia. Like there were a lot of countries, even United States was also a part of it. And so basically, I mean, there were around 12 countries. Now, US has always shown a very tough stance on their trade agreements. So when we look into a lot of, so not only they exited from the Paris Climate Agreement, they wanted to revise NAFTA. They wanted to revise a lot of trade deals. So this is something which they can re-enter into. And the very idea of the Trans-Pacific Partnership is to deepen the economic ties between these countries. So what happens is, if you are a part of this particular agreement, there are no tariffs, there are no duties, and there is a good free flow of trade. But Donald Trump has always followed a very strict policy, and he literally exited from every trade deal which US was in. So now with Joe Biden coming in, we might see that happening again. Very straightforward question over here. Should we invest in stocks right now? Okay, so I'm going to answer this question. Let me tell you the financial markets outlook, and then I'll be able to answer this question better. It's a very straightforward, very good question. Should we invest in stocks? You can invest in stocks, and I'll show you which stocks you can invest into. It's just not going to be your regular Teslas and Amazons, but definitely I'm going to share a portfolio with you. A bit impact on market, a very high impact on market is expected. Dollar is expected to be bearish, which means on the downside against its currencies. Equities, as I said, higher taxes could erode the corporate earnings, leading to lower valuation. So stocks might get impacted. Gold, at the end of the day, a good stimulus coming in, it should be positive in a democratic sweep. Now, this is just for your understanding, a very important statistics I found, and I thought I'll definitely share it with you. If you see S&P 500 returns during every Democrat, with a Democrat Congress, like the situation as of now, which has been created, a blue sweep completely. Look how since 1951 till 2010, how the markets have performed. So if you see, S&P has given most of the time positive returns. Out of this, 4 times it has shown negative, which is Bill Clinton, 1.5%, Jimmy Carter, 11.5% negative, Lyndon Johnson, 13%, John F. Kennedy on the 1962, the second term, 11.8%. That time it's been negative, but most of the time a democratic sweep has been positive for stock market. On an average, it has generated 9% returns, and the percentage of positivity is around 77%. So whenever a Democrat president has controlled the White House and the Congress, most of the time returns have been positive. So this is just a statistics which you can see how historically markets have performed with a blue wave, right? So you can see all these returns, average 9%, 10% gain we have seen with a Democratic House and a Democratic Congress. Now, coming to the point, which are the stocks? Before I move on to the financial markets, let's look at some of the portfolios we have devised. And this is something which you can take a picture of, note it down for your understanding. I'm going to share these portfolios with you. And please keep writing any questions you have. I will answer. I have a lot of questions coming in. I will answer once we end this session. Okay. Okay, let's start. Let's start with. So we'll take this one by one. Perfect. Okay. Let's look at. So guys, this is for those people. Somebody asked me a question, should we invest in stocks right now? Perfect. So we should invest in stocks, but this is the year where we are expecting value over growth. What is value stocks? Value stocks are those who are giving you good dividends, which have shown a great decline. I mean, they have come down, they're available at a discounted price, and they have dividends. Value stocks could have dividends, could not, but most of the value stocks they have. Growth stocks are like Tesla or Facebook, Apple. These kind of companies, they are growth stocks. They're not giving you any dividends, but they are moving so much that your capital kind of increases, but at the same time, it gives a very risky factor also to your portfolio. So you should invest in stocks, but which stocks you can look into is these are the ones which can give you good dividend, and they are low beta stocks. When we talk about low beta stocks mean those companies which are less sensitive to the market movements, which means if S&P falls down by 5%, this stock will go down by just 2.5%. If S&P goes up by 10%, this stock will go up by 5%. They are not very volatile. They're not very market sensitive. So these are low beta stocks, which I'm going to show you. But combined this portfolio, it has a dividend yield of 7.5%, 7.1%. So these are the companies related to energy. These are the companies related to industrials, real estate, defensive sectors, basically, which can give you good dividend and are low beta, low volatile stocks. Because one thing which you need to understand, 2021, nobody knows whether the lockdown is going to initiate again, how effective the vaccine is going to be, and what will be the future of this whole pandemic, which has again started, COVID 2.0, or the strain or the mutation we are talking about. So to be on a safer side, please make note of this. Look into the stocks which can give you a fixed income, a kind of good dividend, and are low volatile. Now, these kind of companies, as I say, when I will scroll down over here, you can see that why we have picked these ones. These are dividend stocks, and these are Bloomberg recommendations also, which are attached to them. We have mostly taken the ones which have a good buy or a hold rating. A very few of them have a sell, but majority of them, their Bloomberg analysts, they have recommended to be on the buying side. Their dividend yields are also better, and comparatively, the all portfolio entirely ends up on a 7% yield. So talking about stocks like MPLX, NLA Capital, Magellan Midstream Partners, Imperial Brands, Vodafone Group, Orange, Phillip Morris, National Grid, and BAE, followed by AbbVie. Now, if you look at these companies, MPLX is from the oil and gas stream. Now, this is one thing which everybody wanted to understand, that when we talk about energy, oil and gas, what over what? Okay, one question also, won't the increase in corporate tax impact on the amount companies can commit to dividend payout? So again, a very important question, very good question. Somebody asked me a question that the increase in corporate taxes, if it happens, as of now it has not happened, but since we are talking about it, will it not amount companies can commit to dividend payout? So see, what happens is dividend is given from a portion of the net income. Now, the reason behind why companies declare dividend is also to attract investors to invest more in their companies. There are a lot of, and I'll give you examples, like companies like ExxonMobil, companies like Coca-Cola. These kind of companies have continued only to increase their dividends in last 20-25 years. So you really have to focus on these kind of companies which have maintained a steady or increased dividend over a period of time. ExxonMobil stocks actually fell down because they did not cut their dividends. Dividend cut happens very rare, not just because of the corporate taxes. Dividend cut happens during pandemics, for example. A lot of companies during the pandemics, they did cut down their dividends, but there were a lot of companies which continue to pay the same dividend. ExxonMobil was one of that. So it's not necessary that increase in the corporate percentage tax will directly impact your dividend. Dividend is something which is taken separately from the net income, and a lot of times companies which had a provision for dividend they have continued to do it. Unless there is a major pandemic kind of a situation, the dividends are not really cut. Increase in corporate taxes does not really hamper the dividend payout. Now, coming with the MPLX company, we saw their quarterly results were very good, way ahead. Their cash flow, so the free cash flow is the amount of cash which is there in the company which can be used later on, which is not blocked. So 2021, their complete agenda is to keep the cash flow increased. They have generated $1 billion of distributable cash flow. It is estimated to give us $746 million disbursement. Now, this is something which is available. If free cash flow is higher, then if the distributable cash flow increases, that is something which is good for the company, because that they can distribute it to the shareholders. Not all of it, but a good amount can be distributed. So that kind of increases the distribution coverage ratio more than one, and it's a good thing. Their forecast is expected to be better. It's a dividend stock, very attractive due to its strong asset base and logistics and storage segment. Their storage and logistics segment is doing really well. Revenues have increased. Post-COVID-19 demand has recovered. And again, we see their capital. So what was the key impact? What was the key factor which improved a lot of revenue, which made a lot of companies actually stand out in 2020? Some of those companies were really quick to cut down their capital expenditure. Some of those companies were really quick to reduce down their variable cost and fixed cost. And such kind of companies actually saved. They saved their status. So MPLX was one of those companies because they have reduced down their capital expenditure, and they have to continue to do that. So this is something which is good, which is going on right now in this company, and it is expected for 2021 that they will perform better. We are taking a real estate company also, and this is Annaly Capital Management. Now for them, again, very attractive choice for those investors who are seeking dividends, because they are diversified. If you talk about, for example, again, their free cash flows have continued to go higher. There is, and if you see their portfolio of securities, they have internally managed hybrid residential mortgage, 80% of its total capital invested in agency. Now, what are agency MBS? Now, agency MBS are directly connected to US government. So if your major portfolio is agency mortgage-backed securities, it kind of gives a protection to the company. The remaining 20% invested is in credit assets. So from a risk point of view, the company is much more sorted. Their core income, $448 million. It came out above expectations, driven up by a stronger top line. So again, the earning per share, it is expected to be higher, and it is expected to outperform the expectations. So from a dividend point of view also, the company is expected to do well. Again, so we have discussed one about oil and gas, one about real estate. This is again oil and gas, a Magellan Midstream Partners. You can note down the name. We'll look into some consumer defensive. Now, consumer defensive, if we see, we are looking at Imperial Brands. Their last quarter results were good. Why I'm looking at last quarter results? Because January is going to be important. January now is the time when October, November, December, how the quarter performed. Last quarter results are going to come now in January. So this is going to be a very important month for those people who are trading in stocks. So be very careful. There'll be a lot of fluctuation in stocks. For Imperial Brands, again, if you see a consumer defensive stock, the importance of consumer defensive stock is what? Even during the recession, these kind of companies, they kind of retain their value and they deliver good dividends because they are non-cyclical in nature. If you're looking at a tobacco company, their demand normally it doesn't get affected, pandemic or no pandemic. So these are kind of non-cyclical stocks which always retain their value and they even provide a good amount of dividend as well. With Imperial Brands, we have. Is it possible you can email these slides? Sure, I can definitely email these slides. Please send your personal emails later on to your relationship managers, and we'll definitely send you these through emails. So about Imperial Brands, again, their consumer base is increasing in UK, in Ireland, France, Australia, and their cash flow is being boosted. So that's a very good thing. They have done one really good thing. Also, they have sold down. They're looking to sell their non-operational assets, which is good. It can maximize their profitability and recover them from the pandemic. So, guys, again, all these companies, we have kept in mind the impact of the pandemic and how they have dealt with pandemic and what is their current status, not just the name or their sector. Followed by communication services, we're looking at Vodafone. Now, without a doubt, I've been personally investing in Vodafone from a very long time. And whether it is Orange or Vodafone, both of them, Vodafone, their earnings have always, mostly results have always outperformed the market. We are looking at a lot of opportunities which are going to come with 5G. I'm not sure how many of you have learned about 5G technology, but companies like Vodafone, Verizon, it is expected that 5G technology would generate a lot of business for a lot of companies. Talk about companies like CCI. CCI create these fiber cables for the towers. And with 5G coming in, there will be a demand for more towers, more leases, and that is something which is going to impact all these companies. So not only you invest into 5G as a technology, but also those companies which are around that technology. Now, with Vodafone, it is open to consolidation opportunities in Spain and across Europe. Very optimistic management. They are going to reposition the market, solid foundation for future growth. And what we are looking at is most important part, that they have a rapid data growth on account of increased 5G presence. That is something which will again lead to new tenancies and new sites. So most of the analysts are expecting a 20-25% increase in Europe tenancies between the year 20 and 25. So that is something which is really important. Look at Orange also, for that matter. I'm taking another company for communication services. In France, in Spain, Orange is growing. They have this momentum going on. They have reduced down their capital expenditure also. Free cash flow, again, is good. So dividend is, again, very good. Their dividend for the shareholder, it is around 0.2 euros per share. And that is something which is really good, because this kind of, if you see the ordinary dividend of 0.70, total cash return of 0.9, which means overall, what you need to understand is, whenever you're looking at a dividend stock, you have to understand the dividend yield. If the dividend yield is high, not extraordinarily high, but a recent, let's say 7-8% dividend yield is very, very good. So if you look stocks like Coca-Cola, stocks like Orange, stocks like Vodafone, around 6 to 8% dividend yield, it's a very good dividend yield to look into. So their user base is increasing. They have delivered a very good performance in Spain. So this is something which is worth noting, and that's why we are looking at these particular companies. Now, again, consumer defensive. If you are talking about consumer defensive stocks, we'll look into companies like Phillip Morris. Phillip Morris, I want you guys to, I'm sure everybody knows about it, but this was something which was not known by many people. Phillip Morris is a tobacco company. It's a very renowned one. And this is something which is has been there for a while, and it has performed really well. And if you look at the entire company, payout, again, the highest priority is on the dividends. They are looking at, even during the pandemic also, there were disruptions, but the company is very much capable of giving a good dividend. We are talking about this particular company, why I've told you to focus on, because when you look at the competitors, rivals. I'll give you one example. If you must have heard about, you must have heard of Darden Restaurants. Darden Restaurants was one of this company, uh, which has the franchisee of Olive Garden and Applebee's, and it's a very renowned franchisee. Darden Restaurants actually survived throughout the pandemic, but all its major rivals they were not able to. So now, after the pandemic, there have been few companies which the competition has kind of washed out, and only the major players have stayed in the market, which is good enough for people to understand that these could be the companies. This is something can be worth focusing on, right? So we'll look into further. One second. Okay, so we'll look into another stocks right away. Utilities, National Grid. Now, guys, again, you're looking at utilities, you're looking at industrials, and again, as I said, we can discuss about. So I have one more portfolio for you, which is completely different from this one, and that will give you a different perspective. So for now, I just want you to write these names, or at least keep a picture of that with you, so you can actually see that which kind of stocks we are looking at, or which kind of stocks we are talking about. BAE Systems, that is again industrial based company. They are, so if you see their interim revenue, it has increased. Good operational performance at its factories that manufacture Typhoon fighters, combat vehicles, and warfare ships. Kind of a company which we don't really talk about much, but if you see a lot of typhoons, lot of floods have occurred in different parts, especially in the United States. So this is something which, again, on a futuristic point of view, you can hold. Good thing about dividend stocks is you can always see these companies performing in the long run, and gives you a kind of fixed income also. So that is something which you can always look into when you are making a portfolio. Okay. Now, once again, since we are looking at different sectors, let's try to understand. Where is it? Yeah. AbbVie, a healthcare stock. We didn't discuss about any healthcare stock. This healthcare stock actually gives dividend also. And AbbVie, I know so many of people who have invested a lot in AbbVie, and AbbVie has given very good. Their earnings have increased by 52%. The revenues have increased by 52%. Earnings to $1.29. Global revenues, again from the immunology portfolio, were 5.79, increased by 14%. They AbbVie, along with Harvard University, they have allowed a collaborative research alliance. Momentum is very bullish. They are going to continue the launch of their very attractive catalyst, Skyrizi and Rinvoq. And this is something, again, they are very much top in the line in when we talk about immunology. So this is one of the most important healthcare stock which you may not have heard the name, or I'm sure you must have heard the name, but look into this stock. And if you want to make this as a part of your portfolio, talk to your consultants also. Most important, guys, all these names which I'm telling you, it is important to talk to a consultant back home as well, because either you talk to us and we'll show you something, or at least talk to your consultants. That is something which can be of your importance. One question I can see, why is Vodafone not performing well in Indian markets? See, I think, obviously, we could do more research on it to understand, but I think that there is a lot of chaos around. See, Vodafone is kind of losing subscribers to its rivals itself, because Vodafone, it trims the coverage. They have cut down their cost. Their payment terms from the government itself have suffered a lot. They have not. So the one major factor why Vodafone is losing in India is they are not able to set a better payment terms with the government. They owe a lot of money to the government, and that is something which is increasing their net debt. If you see in INR, it is around $1 trillion of debt, which has been during June. And I'm talking about a very old news. This was back in June when I was reading about it, because I've not done any much research over the Indian bit. But their net worth has actually turned negative. And when you look at the mountain of debts, it's just they're not able to reach on a good payment terms with the government. That is one of the important factors. Government support is something which is really important for the company, right? Now, coming back, there is one more portfolio which I wanted to discuss before, as I said, we look into the outlook for the financial markets in 2021. And this time we are going to look at a series of different stocks, and then we look at the investment themes of 2021 as well. Somebody said due to aggressive Jio and Ambani. Yeah, I mean, with Jio giving everything for free, it is always a pain for other telecom providers. But yeah, I think if Vodafone had a better payment service with the government, I think that could have been very important. Another stock, when buying stocks or investing, is there any specific pattern you would recommend for first-time investors? For first-time investors, I would recommend not to get carried away with the noise. I'm sure everybody is talking about Tesla right now everywhere. I'm sure everybody's talking about Amazon's and how this tech rally has kind of increased everything. But please understand this thing. S&P's entire rally is mostly governed by the tech stocks. And when you are looking at any kind of, so for a new investor, most important part is look at your age first and see. So for example, if I am 30-year-old, 100 minus 30, 70. So for me, I can invest 70% or 60% safer side into stocks, because stocks can always lead to capital loss also. But I'm 30-year-old, so I still have time to earn more money and recover. But if you're already 60 or 70, should not be very much invested into the tech stocks, because they're very aggressive. They don't give you any dividends. They can give you very high return, but then they can come down also. So you have to understand your risk appetite. And as a new investor, I think you should definitely start with low beta stocks, which can give you fixed dividends. And I'm talking about defensive sectors. Defensive sectors, as I said, like healthcare, utility, something which is non-cyclical in nature, something which does not get affected by pandemic, right? So that is something which you should look into with dividends. Do not invest into cryptocurrencies. Never invest into cryptocurrencies. Always look forward to make a portfolio for yourself. Growth stocks can be there in your portfolio, but then again, the growth stocks on the likes of Amazon, for example, or tech stocks which are related to something which is more futuristic, companies that increase the speed of internet, companies which are related to financial technology, innovation, AI, robotics, those kind of companies, something which is much more futuristic. So you can also invest a lot. By the way, this is for the new investors I'm talking. You can also invest into renewables, because one thing for sure, in the next 4 years, we will see a lot of encouragement to the renewable energy stocks, with Democrats coming in, and a lot of focus on green and clean energy and climate change also. Invest into companies which are mining lithium, because lithium is the source of these batteries which is fitted into electric vehicles. So look into those kind of futuristic companies. Do not get carried away by what you hear. Facebook, Netflix, Googles, and Teslas, these companies are always going to be there. But for you as a starter, you have to be on a lower risk side where you can get a fixed income. And even if the market goes down, your stock should not be that sensitive to the market index. So, and these companies can be really easily be found with the help of a financial consultant. For a new investor, how about safe ETFs like VOO? Of course, I mean, we'll look into more into this particular ETF as well. You can invest into an exchange traded fund, and I'm just showing it to you right now. Good that you asked. Let me show you this time one more portfolio we have been working on. Okay, now check this one. These are companies. Now, again, this is for people who have been in the market for a while, but also for new investors. This is something which you can see. This particular portfolio continues. It has companies like Wynn Resorts, companies like Southwest Airlines. Now, first thing which you will ask me, why hotels and resorts and airlines, given the fact with the pandemic and everything. So, guys, pandemic 2020 was a bust for everyone. Now, with vaccines coming in, the major risk for every outlook I'm going to give you right now is going to be that given situation remains normal and vaccines do their job, and the time again not the same, but at least it becomes normal, recovery happens. So that point of time, these kind of companies might start recovering and reach to their original levels before pandemic, right? So you can actually get a good cream out of it if you at least enter into those mode now, because with vaccines coming in and with global markets recovering in 2021 and 2022, we might see these stocks again coming up. So you have companies like Southwest Airlines, you have companies like Wynn Resorts. A new addition to this, something which is really focused. Please note this down. Teladoc Health. It's a healthcare technology. This is the era of healthcare technology. If you want to invest in technology, don't go for Facebooks and Teslas always. Look forward to the technology which is helping healthcare, which is helping internet to increase its speed, companies which are helping more innovative ideas, right? So Teladoc Health is how you can treat a patient, and Teladoc Health is more like a tele-doctor, as the name suggests. So these are few areas which you may not have heard before, but this is something which you can definitely look. Then Adobe, DocuSign. DocuSign, we personally use DocuSign because any account opening which we wanted and the document needed to sign, we actually got subscription on DocuSign because we could not meet clients. We had to send them document. They can sign it over there, and email comes to me and goes to all the respective parties. So DocuSign was again a very good technology help. Adobe, Bandwidth Inc., CrowdStrike Holding. CrowdStrike is a cybersecurity sector stock. So cybersecurity, again, guys, this is my idea of tech. If you want to invest into technology, go for companies like Salesforce. Salesforce did a partnership with Slack Technology. They have acquired Slack, and they have recently cleared a $10 billion worth loan as well. Their deal will work out. So Slack is also one of the tools which was used for organizational purposes, an organization working on a specific project. You don't have to meet, you don't have to connect. You can actually be connected on Slack and track the performance of the project individually on the app, and all the parties can communicate with each other. So companies like Salesforce, companies like CrowdStrike, companies like DocuSign, they were those companies which actually helped a lot during the pandemic. Now, one question is this going to not perform well once the vaccine comes in? Because these are kind of a work from home stocks, right? Which have done really well during the pandemic. So I'm not asking you, that's why I showed you 2 portfolios, 3 portfolios, for the very same reason, that you don't invest into only work from home stocks. You don't invest only into tech stocks. You make a big portfolio out of it, where a specific thing goes to a specific. Now, Salesforce is very important. Why? Because their acquisition with Slack is one of its kind. The stock also, for technical reasons, the stock is down, available at a discounted price, a good entry point is expected. So technicals and fundamentals combined, we have put these companies into it. The next revolution is from genome stocks, of course, the top stocks from the ETF. There are a lot of companies. So guys, again, as I said, a lot of ETFs are available on this particular platform, and you can look into companies which are related to genome stocks as well. And see, so companies which are related to genome sequencing, we're talking about, again, a complete DNA sequence of an organism's genome at a single time. And this is again important because this area is also increasing a lot. You will ask me, what is the purpose? This kind of will tell it kind of gives you a genetic information that is carried in a particular DNA segment. So, for example, uh, say scientists can actually find by using a genome technology that what is in a DNA, what kind of information or what kind of sequence does a DNA contains, what kind of genes does the DNA contains, and how it carries the regulatory instructions to the mind. So this is something which is a really increasing area. And if you even read about it, you will see that this is something which has been going on now. The cost is from $1,000 to $4,000, and there is a lot of scope in the companies which are related to it. So you look into these kind of companies, and I'm sure a portfolio can be created when you look at different financial services. Looking at Citibank, Southwest Airlines. Southwest Airlines has one of the best balance sheets when we compare the airlines to others. Then there is Starbucks Corporation. There is Six Flags Entertainment, which is e-commerce company, right? CVS Health, which is a healthcare company. So guys, this kind of companies can really help you out. Teladoc, I was talking about, I actually wanted to focus more on Teladoc. Now, during 2020, the company's services have increased because it was a year of COVID, and as much digital and remote healthcare services a company can provide, that what Teladoc did, and it actually, you say seize the day. They did actually seize the day, and their product has become very strong, and it is kind of convenient. Pandemic or no pandemic, it has shown how convenient this can be. Like, you can literally call and you can diagnose yourself over the phone. So this is something which, guys, again, it's an emerging area for newcomers. If you're young, then definitely you can always experiment on companies like this, because these can be very big in the future. So by the time you grow your age, you will reach to that particular point, right? Now, excuse me, coming back to the presentation, we had to discuss about the outlook for the, right here, excuse me, financial markets 2021. So financial markets 2021, what we have in picture, we are looking at stocks. I'll show you one portfolio where I'll show you Japanese and Turkish based ETFs also. So between Europe and Japan. So guys, I've shown you a lot of portfolio from US. I've shown you some stocks from Europe also, companies like Orange, etc. You have to focus more on different parts of the world as well. So Japanese stocks, for example, they have particularly large allocations, very attractive deep cyclicals, industrial, consumer discretionary equities. They're very discounted price as of now. We are looking at, as I said, value stocks as compared to the growth over the next particular few years. So instead of focusing more on the Facebooks and Teslas, try to look into the value stocks which are at a very good discount. And you can always talk to your consultants. They can provide you some good, a lot of stocks I showed you which were value stocks right now. Risk includes, as I said, a complete election sweep of Democrats, tax implications on the overall stock price. That could be one idea. But guys, understand one thing also, with pandemic, there possibility of increasing taxes by the government, that will also take some time. So the impact may not be very high, given the central banks have kept their interest low. There's a lot of stimulus coming in, so overall impact on the stocks might be positive. Just not the tech sector completely, because tech sector is something which has rallied a lot. So I would refrain you from going into, and when I say tech means the usuals, the Teslas and the Facebooks. COVID spread and shutdowns, again, it's a major risk. If it continues, then all I'm saying would not make any sense. So you have to be very careful against that. Near market technicals, we look at bonds. The emerging market bonds have witnessed significant inflows. So look at emerging market bonds, guys, because emerging markets are expected to improve in 2021. So that is something which can give you a good idea. Again, investors should consider allocating a portion of their portfolio to core government bonds regarding of their valuations. So maybe the bond yields start increasing. This is the year also when central banks, maybe by the next year beginning, they might start tapering the bond purchase, which means this stimulus they might start wrapping up also slowly and gradually. So if you're looking at bonds, government bonds are the best, but emerging market bonds also you should look at. Emerging markets like Indian or Japanese or Chinese, for example. Currencies, dollar is expected to be continuing on the downside. I told you about pound. If there is negative interest rate coming for GBP, then pound can also be bearish. International growth will depend on regional pandemic trends early in the year, but should accelerate once vaccines are distributed. So that's really important. A more predictable trade policy from Biden, a stronger international economic growth should push US dollar lower. So that's what is expected. So dollar is expected to be on the downside for 2021. That is something which you can keep a check on. And please, for those people who have exposure to pound, keep a high check on how the pandemic is dealt with and how the Bank of Governor decides on the monetary policy. If they push to negative rates, then we might see pound again on a bearish territory. Commodities. So gold, definitely we saw a very good upside in 2020. Very volatile asset. Gold is expected to be higher in 2021 as well. Even silver also, palladium, platinum as well. And we are looking at these kind of metals. Why silver is expected to go higher? Because global recovery will push silver prices higher as an industrial metal. And gold prices are expected to be higher because interest rates are still down and a lot of dollars are being injected into the economy. So dollar is devalued against gold and gold is being higher on the value. Energy remain dependent on the vaccine deployment. So eventually it depends if pandemic comes in again, lockdown happens and oil prices again might drop. That could push INR much higher, but then we are looking at a lower oil prices if the pandemic is not controlled. So that is something which you should look at. Emerging markets like China, India, these kind of, again, a lot depends on the vaccine. But guys, let me tell you this thing. A lot of emerging market currencies are expected to become stronger. So that is something which is a kind of, if with Biden coming in, the trade tensions, the trade war is expected to, at least the tensions are expected to ease down. So the global growth, global recovery first will hit emerging markets. And when I say hit emerging markets, that means it will be more positive for emerging markets because US market has already rallied a lot. So you should focus on emerging market equities as well. And I'm going to show you which emerging market, how you can invest into emerging markets as well, not just provide you this. Some multi-assets understanding. If you see commercial real estate might bounce back against the housing, because with the global recovery coming in, maybe commercial real estate again could be of a better understanding. High yield bonds over investment grades, that is also one thing. Major central banks are likely to keep policy rates at minimum. So that is for one. Guys, also you can invest into bonds which are connected to inflation. So if you want to hedge the inflation, you can look into those US government bonds which are called TIPS. Treasury inflation protected securities, which are available with the US government. You can invest in those bonds, very low volatile. You can look into these kind of bonds and if you want to hedge the inflation risk. So that being said, let me also show you one way how you can invest into emerging markets before we finish this. This was something which we were... Yeah. So this is I wanted to share with you before we leave. Here, let me see if there are any questions. I have one question in. Gold has been down by over $150 in the past 4 weeks. About, is this a good time to invest in gold? Do we expect the price to start picking up again? Good support for gold is around 1860 levels, was a very good support. Now, again, every time it breaks 1860, it goes down to 1840 and bounces back. A break below 1800, the price can go to 1760. 1760, very good support. 1860, very good support. Resistance at 2000. So for now, just understand this way that if gold comes down, it's a decent buy price because the uncertainty to pandemic still prevails. Even after the vaccines coming in, there's a lot of injection, there are a lot of stimulus which is going to be injected. And now with a democratic sweep, a lot of more stimulus might be there in the coming next 4 years. So gold prices are expected to be on the higher side with the central banks all over the world keeping interest rates lower. So yeah, I mean, I think a decline of $150 today itself, I think gold has went to 1860, came down to 1838 again. So you can play around with that range, definitely. Now, for emerging markets, guys, you can look into these funds which are related to Japan and Turkey and Chinese consumer discretionary. These kind of ETFs are very easy to invest in. You can use our platform to invest into these ETFs. Just one second. Yeah. So trend is expected to be on the higher side. There's a resistance also given where you can book your profits and what is the current market price. Chinese consumer discretionary ETF fund seeks to provide investment results that correspond generally to the price and yield performance before fee and expense of the Chinese consumer discretionary index. With vaccines coming in, higher risk appetite and weakening of the dollar, since growth in other parts of the world will outperform that of the United States. This should benefit emerging markets. So guys, this is again a portfolio of Chinese stocks. You can see Alibaba, JD.com, Neo.com, TL Education Group, Yum Brands, BYD, Build Your Dreams. So this is a top fund. Top holdings of this fund are companies which are related to e-commerce, companies which are related to electronic vehicles, companies which are related to education and food stuff also. So this is something which you can look into. If you want to invest, you can invest directly into this ETF and get a mixture of Chinese equities. Then there is Japanese ETF. The top holdings are Toyota, Sony, Nintendo, Nidec Corp, Daiichi, Recruit Holdings. So this particular fund, it focuses on the performance of the Japanese market. Index stocks in a variety of sectors using a market cap weighted portfolio sampling. So if you see, if Japan continues to have positive yields, asset will retain its attractiveness for overseas investors. Being a manufacturing dependent economy with a lot of powerful consumer brands, it should help Japanese companies post strong global sales in 2021. So emerging market ETFs is also one investment which you can do. Then there is Turkey ETF. Now Turkey ETF, again, inflation is very high, real interest rate negative. Lira has performed worse among the emerging market peers, if you see. So now the new governor of the central bank again has established something. They have talked about giving some stability to the financial markets, and they have started delivering those expectations. So monetary policy is getting reinstated. So this is something, guys, again, when you talk about monetary policies of a country, that can also impact the stock prices. Turkey, if they reinstate their old monetary policies, it might turn some positive sentiments towards it. So a part of your portfolio can be into Turkey-based ETFs also. Why ETF is for the same reason that your risk is spread into different emerging markets. Then there are some sovereign bonds, but these are actually high-risk bonds. This is for people who are adventurous or aggressive in nature. Maldivian bonds and Sri Lankan bonds, they have very good yields, and their bonds maturity is also very close in 2021 and 2022. So the yields are very high, but then risk is also very high. Sri Lanka is still getting support from this new political party. The government is much more stable, and a lot of foreign investment is expected to come. Maldives, again, they were on a risk of default, but their bond yields, that's how the bond yields have grown up. So this is, again, as I said, for a very high risk or aggressive investors, because these bonds have a maturity of 2022 and 2023 in the next 2-3 years. And they are triple C. So obviously the rating is not good, but the yield till maturity is 18% to 27%. And you get yearly 7% coupon, 5% coupon on these bonds, which means interest. So if you are aggressive in nature, you can look into these kind of sovereign bonds. You are conservative in nature, you can look into government bonds, inflation protected bonds, and we can suggest you, we can consult you with all of this. So guys, what we discussed today was something which I always wanted to share with you in the very beginning of 2021. So the next entire year we can have a particular plan, and we can move along with this plan, because our consultants can help you to keep a portfolio open along with this, and we can suggest you which currencies can be better, how you can devise a portfolio for yourself, which are the sectors which are emerging, which are the sectors which have outperformed, which are underperformed, which has good dividends. So your portfolio will be a mixture of, I told you how you can diversify it. Your portfolio could be a mixture of companies with high dividend and low volatility, a bit of growth stocks, a bit of futuristic stocks, some ETFs in emerging markets, a couple of bonds in emerging markets, and government bonds as well, followed by some strategies which are market neutral. Now, what are those market neutral strategies? I will explain you on 19th of January. I'm conducting a session on trading strategies, and those trading strategies contains market neutral strategies, which means those kind of strategies which does not get affected by market ups and downs, right? This will be in the form of seasonality patterns, pair trades, ratio analysis, and a lot of more coming in on 19th of January. So that will be a separate segment which I'm keeping for the next. For those people who want to have a one-on-one session with me, please talk to your relationship managers, and I will definitely be able to talk to you one-on-one over Zoom, or if you want to come to the office, we can discuss the same thing in the office. One question was there, the exception of Tesla, why have most growth stocks been down since last week in December? So the first point was, with vaccines coming in, it did hit the stocks. Second point is with the current democratic sweep, with Biden coming in with complete majority, a lot of tech stocks have come down due to this particular reason. And needless to say, the question of the pandemic and how it is going to impact the economy is also a one factor. So all this completely together will have a long-lasting impact on equities. And that's why we have to continuously rebalance and diversify. We cannot be stuck to one specific. So don't get involved with the Facebooks and the Teslas. And why I'm taking these names, because they are the ones who have performed very good. And I mean, if you want to take a position, but do not dedicate your portfolio to these companies. There are a lot more companies which are a little different sectors. I just showed it to you. So you want to have a one-on-one session with me, please talk to your relationship manager, and we'll connect on Zoom. We'll definitely discuss this portfolio again, or I'll give you a hands-on demonstration on how to do buying and selling, and how to manage your risk, and how to take these trades in your live account. Till then, we'll meet again on 19th of January, 7 to 8 p.m. once again, and we'll discuss about the trading strategies which we can do for this particular month and in the coming next few months. So my name is Yogesh. Once again, thank you so much for being a part of this session. I always love this crowd. These are so many people who have attended these sessions before, a lot of new crowd to look at. And anyone who has a person or who has a relative, friend, colleague in healthcare or medical sector, on behalf of Century Financial, my team, my family, and myself, a big word of thanks to everyone who's out there risking their lives in the healthcare and medical sector. I know this pandemic is not over, but with the new year, all we can wish is a better year coming ahead. And from our side, there will be a complete support and trainings provided to you free of cost. Please feel free to book your sessions. I'll be available. If you like this session, do review us on Google, guys. It really helps me to continue and do more and more research and bring new and more information for you. We have been doing these webinars for a very long time, and I tend to continue this trend throughout this 2021. So please review us on Google, send your feedback, book your sessions, and we'll meet next time again on 19th of January. Till then, please keep yourself protected. Wear your mask, use your sanitizers, be safe, I'll see you once again. You have a great night. Happy New Year. We'll meet once again then.